Okay, everyone, you survived tax filing season, but it's going to present us with some opportunities to discuss the importance of what came back with your tax return. Did you get a refund? Did you owe? What does that mean? How do you analyze that? And let's get even a little bit more advanced. How can we transform our tax return into a springboard for financial planning? And to help us with this, we have Sean Mullaney, the FI tax guy, on the ultimate crowdsourced personal finance show. This is Choose FI. All right, guys, very excited to dive into this week's content. And we're going to be talking about tax planning or tax returns as a springboard for financial planning. But Brad, in the setup for this episode, we kind of I mentioned this whole idea of the refund. And I can tell you as a 16-year-old, as an 18-year-old, but heck, as a 28-year-old, many of my peers are very excited about the vacation that they're going to go on with their expected $2,000 refund that they get every single year. And I think before we even get to the more advanced stuff with Sean, it's really important for us to address that logic and why we would just put a pause on it.
Yeah, I mean, I think this is one of those items that is like the biggest difference between people in the FI world and people outside the FI world, right? So for those of us in the FI world, we have a significant savings rate. We're not worried necessarily about cash flow and, oh, can I pay the bills this month, right? It's how do you spend according to value, as opposed to people outside of the FI world. For many of them, their biggest form of savings, or really that one lump sum, comes each year when they get their tax refund. And it's a bonanza, right? Like you said, it's $2,000, $3,000, $4,000, whatever it may be. And that is something that they use for a vacation or to, pay down debt or something. And it comes in this one lump sum. And if that is your only means of savings, then, I can actually obviously understand the allure of that, right? But for those of us in the FI community, it's suboptimal. I think that's the phrase you used, right? Or I know that's a phrase you love using. So it's suboptimal because in essence, that is your money, right? Like that is your money that you have given as an interest-free loan to the government, in some cases for 12 plus months, right? And that is money that could have been on your side of the ledger. It could have been invested in your accounts. It could have been earning interest or compounding or doing whatever, investing in some regard for you, as opposed to, hey, I sent this money off. And because really that's what it is. When you send money off in your withholding each paycheck, or if you're self-employed, you have estimated tax payments, you're basically just saying, okay, I'm going to have a federal tax liability, which is actually the amount you owe, right? That's when you file your return and you figure out, you do all the calculations and you come down to, hey, this is my actual liability. So let's just say arbitrarily that's $10,000, but you have paid in, you have withheld $15,000, right? That means you have a $5,000 refund, a $5,000 overpayment. And again, that's money. If you had sent in exactly $10,000, you would owe zero. That would be the perfect return, right? You would get $0 refund.
We've had a couple people that have acknowledged, like, raise your hand. That was me. And for you guys, like, if that has happened, take a screenshot. Like, we'll try to send you a Choose FI t-shirt or something. I mean, you're winning awards here. It's incredible.
Yeah, that's pretty remarkable to get it exactly spot on. But in that case, you would have had that extra $5,000 throughout the entirety of, let's just say, we're talking about the 2020 tax return. You would have had that money in 2020 when, Jonathan, we know what happened from April, May on, right? I mean, obviously it's hindsight bias, but the stock market exploded. If you had invested that money, it would have done pretty well for you, right? As opposed to it just sat there on your account with the IRS and really did nothing for you. So, again, hopefully I'm making the distinction clear of, like, I can understand for people who have no savings and would have spent that money along the way, that almost having this forced savings of, okay, I'm going to get this big refund and then I'm going to do something good with it. Okay. I think there's logic to that to some degree. So, hear me out. I'm sure there are people yelling at me right now, but I genuinely do think there's logic to it. If you would have frivolously spent it one paycheck at a time throughout the prior year. But again, for those of us in the FI community who have big savings rates, it really doesn't make sense. It's suboptimal to have a big tax refund.
And so, the first year it happens, amazing. And then use that to, maybe pay off debt, pay off high interest debt, get some sort of emergency fund or emergency stash set aside for yourself. But then it's, when we talk about someone being in this situation for 5 years, for 6 years, for a decade, like if it's the same amount that you're getting each time, go to your HR department if you're unfamiliar with how to do these calculations, and you'll likely end up making some adjustments to what's called your W-4. It's something that many of you, you set up when you first got the job and then you never thought about again. So you can actually make adjustments to that, and your HR person can likely help you figure out what would be an appropriate adjustment to make. And you could try to get this a little bit closer and then reclaim that money. If you're getting a $6,000 tax refund, then that's legitimately $500 a month that you could have had over that duration to do with whatever you want. So it's not that we don't want you to have the money. We just want you to have the money sooner to use for whatever your goals are. And in many cases, for many of us, it's to reach financial independence faster.
Yeah. So, Jonathan, I guess, this is us talking about the importance of the refund, but really, your tax return is one of the best tools for understanding your financial life, right? Like there's almost no better place to just see in black and white, hey, these are the dividends I'm getting. Here are the cap gain distributions. Here's the income I'm earning from various sources. Here are my credits and my deductions. I mean, this is a really powerful tool. And I think a lot of us just kind of close our eyes to it and just let somebody else do it or not think about it. And what's so cool is Sean Mullaney, the FI tax guy, came to us and said, hey, this is something that can actually help springboard your financial planning. And this is something we really need to dive into. So, Jonathan, obviously we got Sean on the show, and yeah, Sean, welcome back for the you many times here on Choose FI. Thanks for being here.
Brad, thanks so much. Pleasure to be with you guys today.
Sorry you had to suffer through our kind of meandering approach to optimizing your tax return. I'm sure there was at least 5 times through that little monologue that you wanted to hop in there and do a slight update or correction on something that we said. But we definitely knew when we reached the end of our limitations. And so when we actually move to this whole concept of the springboard from tax return to financial planning, this is something that we're very, very excited about. And we'd love for you just to introduce this idea to the audience.
Yeah, Jonathan. So this is all about taking action, right? So this is, hey, I've completed my 2020 tax return. That's been filed, right? So the IRS has it. Either I've paid my balance due or I'm about to or already received my refund. All right, well, I have this document, what can I do with it? Is there a way I can use this to marginally improve my financial life? And I'm here to tell you, yes, there are things that you could do practically where you could take a look at specific numbers on that tax return and see if you have maybe an area where you can improve your life. So I think this is about, hey, not that there's a one size fit all solution for everyone. This is, hey, I can strategically look at this document and improve my financial life.
All right. So we have this document. It's a somewhat lengthy document, depending on whether or not you're on the easy form or you've kind of graduated to having more investments with returns, et cetera. What is the form? What is the first, form that we look at that we're interested in? Because many people just do go to H&R Block or use TurboTax, and they end up just getting some sort of easy form. It's a one pager and they're done. Is there data on that form that would be valuable for people?
Yeah. So the first form and line I'm going to recommend folks look at is something called capital gain distributions. It's on Schedule D, line 13, right? So if you've got your 2020 tax return or even your 2019 tax return, you could look at them both as part of this exercise. Take a look at Schedule D, line 13. That's a very interesting number. And that's a number ideally we want to be very low. So what the heck is a capital gain distribution? I didn't go to school to learn about a capital gain distribution. Capital gain distribution is an amount of income that's reported to you when you own a mutual fund or an ETF. Some of these things are inevitable, right? Meaning, if you own any sort of mutual fund that has equities, stocks, even bonds could be in there, from time to time inside that mutual fund, they're going to buy or they're going to sell shares of different companies, different bonds. sometimes that will trip a loss, right? Because the mutual fund bought it for, say, $100, they sell it for $90. That's a loss. That doesn't really have much of an effect. But oftentimes, hey, they bought it for $100 and now they're selling it for $110, right? The $10 delta, that gain inside the mutual fund, gets allocated to all the different mutual fund shareholders, including you. Well, okay, fine, we get this. There's these things called capital gain distributions. Unfortunately, they're allocated to you, and then you have to pay capital gains tax on them. Well, how can I use this to improve my financial life? Well, you should take a look at your mutual funds for many things. And I'm not here to give anyone investment advice, but I am here to say tax efficiency is a good thing. So if you own a mutual fund within a taxable brokerage account, you have to pay the tax on it every year for its dividends and its capital gain distributions. You want to take a look at, hey, does this thing trigger a lot of these capital gain distributions? And if it does, and you have other investments you'd want to invest in that might have lower capital gain distributions, this might be a good time to think about reallocating your portfolio. Now, a couple thoughts on that. One, index funds tend to have lower capital gain distributions, right? Because what they're doing is they're tracking a passive index that's published by a third party, Standard and Poor's, Russell, different institutions, publish these indices. And generally speaking, you don't have to sell too often to replicate that index. It does happen from time to time, but you don't have to sell too often. So index funds, which generally tend to be popular in the FI community, are generally pretty good in this score, right? They tend not to have too high a capital gain distribution every year. And then the second thing is these actively managed funds sometimes can have high capital gain distributions because they're actively managed, right? So they do more buying and selling, and the more selling, the more capital gain distributions. So this is an area where you can look at this one number on your tax return and say, hey, is my portfolio as tax efficient as I would want it to be? And if it's not, if it's like, wow, I've got a big number there, maybe it's time to reassess your portfolio and perhaps reallocate into other investments that you would potentially prefer.
Hey, Sean, quick question. So I know you kind of talked about this just in the last minute or two, but I got an email that I'm going to kind of paraphrase because I actually have been trying to find it here in the last 2 minutes, but could not. So basically, a woman wrote in to us at our feedback@choosify.com email address and basically just said like, hey, I'm not sure why do I pay tax on every year on my investments? I thought it was only when I sold.
That's a
And
great question.
right, like it's for a CPA, like, hey, this is something you think about all the time and it's obvious to you, but like this
Yep.
is really not obvious to anybody. Could you just give like a real high level overview of that?
Yes. And let's do it in the equity context, at least first, right? So whether you own one company's stock, right? So you own, let's just say Apple stock, right? We're not giving investment advice, right? But just say you own Apple stock, right? There are two ways you can make money on Apple stock, right? One is you buy it for, you buy low, right? You buy it for 100 and then you sell it later on for 200. You sell it for more than you bought it, right? That's one way to make money on a stock. The second way is something called a dividend, right? So companies from time to time, and it depends on the industry, it depends on the nature of the company and how successful it's been. But what companies do is from time to time, they pay out some of their earnings to their shareholders in the form of a dividend, right? So maybe you own 100 shares of Apple stock and they declare a $1 per share dividend. That means you as a shareholder are going to get $1 per share, so a $100 dividend. If that's held in a taxable brokerage account, that's a taxable dividend to you. So in January, February, March of the following year, you're going to get a form called a 1099 DIV, which I sometimes refer to as a bill, right? Because what it is it's this form that says, oh, yeah, okay, shareholder, during the year, we paid you out $500 in dividends. And they report that to you. You then put that on your tax return and you have to pay tax on that. But they're also reporting it to the IRS. So the IRS knows, hey, shareholder received $500. When they get that 1040 from you, they're going to expect to see that $500 dividend on there. So that's what happens. And that's part of the reason why we like retirement accounts, because in retirement accounts, you get these dividends, but you're not currently taxed on them. Taxable brokerage accounts are not a bad thing at all, but they do have this so called leakage, right? Where, yes, dividends are paid by companies and then you have to pay tax on that. And then when you go from one company's stock to a mutual fund, right? So I own, say, the S&P 500 index. Now I own 500 different companies. They're all, now I've got this situation on dividends and on these capital gain distributions, right? You know, the 500 companies in the S&P 500, some of them pay dividends, so that goes on my 1099 DIV. I pay tax on that. And then inside that mutual fund, on occasion, they have to sell stock, right? Maybe a company fell out of the S&P 500 index. Maybe a company got merged. Acme gets merged with ABC company, and so I have to sell my Acme shares. And maybe I get ABC shares back. Maybe it's non-taxable, but maybe I get cash back, right? We could go into that. But Brad, to answer your question, yes. So there are going to be times where investors own stock or mutual funds, and it's going to create taxable income other than just selling those shares.
Right. So there, in very broad terms, for most people, they're going to see three different ways their investments are going to be taxed, right? So you're saying dividends, the capital gains distributions, and then the actual capital gains when you sell, right? From
Yes.
in very broad strokes, those would be the three. And like you were saying, so for most people, when they get dividends, many people reinvest the dividends, right? So like they're actually not even seeing the income. It's just kind of getting rolled back into purchase additional shares, but that is reportable income on your tax return. So, that's kind of hard for a lot of people to wrap their minds around, because it is income. It's reported on your tax return, but you did turn around and repurchase shares.
That's exactly right, Brad. You're not able to transmute income into non-income based on what you do with it, right? So if I own 100 shares of Apple and they pay me a $1 a share dividend, that's $100. I can go, buy Dodgers game tickets with it. I can go to Vegas with it. I can go to the grocery store with it, or I can buy more Apple stock. Regardless of what I do, it's going to be taxable income to me. This actually leads us to one of the things to consider about this potential strategy of reallocating your portfolio in a tax efficient way is capital gains, right? So it might be, hey, I own an old mutual fund and it's tax inefficient. It distributes a lot of these capital gain distributions. I want to reallocate into something I like better, and that's going to be more tax efficient. Well, okay, that's a good initial plan, but you do have to run that through the filter of, well, I might trip a capital gain today by selling those shares, right? Maybe I have a loss in those shares. So maybe I have this mutual fund, I bought it for $100. It generates a lot of capital gain distributions, but now it's only worth $90. Maybe I just sell it, right? Because it'll trip a capital loss and there's no additional tax to me. And I might be able to use up to $3,000 worth of that capital loss this year, right? But maybe I bought it for $100. It's now creating these capital gain distributions, but now it's worth $200. Well, maybe I just have to either live with that, right? So what I might do is I might say, look, it's a good problem to have. I'm just going to have a bunch of capital gain distributions. It's now worth $200. I don't want to trip it an even bigger capital gain. Or there are strategies you can employ. One of them is charitable gifting, right? So one great way to sort of hive down an old position with a big capital gain in it is to slowly use that as your currency to give to charities as opposed to cash. Particularly in today's high stock market environment, I think that's a great strategy. So you say, hey, there's the annual appeal at my church, or there's some charitable endeavor I want to support. I'm not going to give them a $500 check or a 100 or $1,000 check. What I'm going to do is I'm going to go into my taxable brokerage account and I'm going to direct the financial institution to give roughly $500 worth, $1,000 worth, whatever it is, of this appreciated stock to the charity. And many charities now can accept appreciated securities, or any sort of securities. Generally speaking, we want to do appreciated securities, and that's a way of getting rid of a old cat and dog in your portfolio that perhaps you don't like so much, but that has a big capital gain in it. You don't trigger the capital gain when you give to a charity. And then you might be able to deduct, depending, we could talk about this a little later, you might actually be able to take a tax deduction for that transaction to boot, right? So you're winning on two ends. You're avoiding a capital gain and potentially getting a charitable contribution deduction on your tax return.
I think I need some numbers in order to like
Yes.
appreciate that strategy. So like, I purchased this amazing stock or this ugly stock, but it has this ugly stock that has a great year. And so, I had 50,000 in this stock, and now at the end of the year, it's now praised at 60,000. I look at Schedule D, line 13 of capital gains. This is the only thing that I own, and it says that I have $10,000 of capital gains distribution. I guess, something along those lines. Just for the sake of simplicity, I realize there's some nuance that got missed there, but $10,000 is showing up. I don't really like this stock, and I don't really like the idea that I'm getting a tax bill based on that $10,000 of capital gains distribution. And so I do plan on donating money to my church every year. And I'm saying, all right, I wonder if I could do this in some sort of strategic way. So what is using this example, what's happening there? And then how is that helping me?
Yeah. So just one clarification point. Capital gain distributions are not going to happen with individual stocks. They're going to happen with mutual funds and ETFs.
Okay.
So just so that we're level setting there.
So great. So this is an ETF, ugly ETF that had a great year.
Had a great year. So what you could do is, and you're saying you bought it for 10 and now it's worth.
Oh, so I had, my base was 50 and now it's, 60 or something like that. And anyways, $10,000 is showing up under Schedule D, line 13.
Yeah. So you don't like that result. And so you say, hey, I'm planning on making a sizable charitable donation anyway. Right. So part of this is, you should be planning to otherwise make a sizable charitable contribution. Right. So what I would tell you, Jonathan, is, hey, what you could do is you could move that ETF to the charity as long as they accept securities, which a lot of charities now do. So you move the $60,000 worth of securities over to the charity, you transfer that as a charitable gift. That $10,000 capital gain that you had in that because you bought it for 50 and now it's worth 60. When you transfer it to a qualified charity, that vanishes. So you'll never pay the tax on that $10,000. That's great, right? That's some good planning. But here's the other thing. Subject to some limitations, you could probably deduct as a charitable contribution the fair market value of that stock. So not only did we avoid a $10,000 capital gain, which is nice tax planning, we now may have put on our Schedule A, our itemized deductions, a $60,000 deduction. Now, look, this is subject to some limitations, right? So it may not be you might not get all 60,000 this year.
60,000 as the deduction. That's not money in
deduction.
That's subject to your marginal tax rate and other factors that go into your tax return.
You got to run it through the marginal tax rate filter, and you got to run it through. There are limitations on the ability to take deductions. They're actually pretty high these days, but there are limitations. You can't just wipe out all of your income with a charitable contribution deduction. But if you're talking about a much more modest amount, like a $500 amount, $1,000 amount, that's one of the nice things about these is that these sorts of contributions are customizable, right? So you might own 5,000 shares of a mutual fund or 5,000 shares of a stock. You can donate 32 shares. You could donate 249 shares, right? You could donate all sorts of any sort of different amount or quantity. So this is sort of a customizable strategy. And so I like it as hey, I have charitable contributions in my life that I make just every year. Maybe this is a way of hiving down, we're in a situation where we have a highly appreciated stock market, and there are folks who maybe they worked for an employer and now they don't, and they have that old employer stock and it's through the roof, or they bought a tech company and it's gone through the roof, but now they're like, oh, I don't like having all that in a tech company. Well, here's a way of slowly hiving that position down that avoids the capital gains tax.
Hey, Sean, I want to just kind of ask a clarifying question / make a point just to make sure that we're all on the same page. Because, obviously we're coming up with this example on the fly.
Yes.
So some details that, we probably want to be clearer on. So, okay. I guess the limitation that you spoke of, is that an income limitation to get charitable deductions generally, or are there limits on this specifically of donating appreciated stock, and I don't even need like what are the limitations necessarily, but just trying to understand, like, let's say Jonathan, for instance, Jonathan's gonna donate to his church. He believes that if he if he donated with regular cash, he would get the full charitable deduction. But if he decided, oh, I heard Sean talk about this, I've got some appreciated stock, this makes sense, right? Like, will I get the deduction and then not have to pay ultimately capital gains tax on that built-in unrealized capital gains? So like that to me seems like a double win, but I guess I'm just trying to understand very specifically, like in that scenario, let's say, Jonathan is, Jonathan, sorry, buddy, we're just using you as an
Throw
example
me
here,
under
but
the bus. Just make sure the IRS doesn't hit me.
Yeah, just somebody making 80 grand as a family, they donate to their church. Realistically, can they do this with the appreciated stock, or are there things like, what are the things they need to look at?
Yeah. So generally speaking, these limitations are based on adjusted gross income, which we're going to talk about a little later. And for appreciated stock, it's generally 30% of the fair market value, right? So let's say Jonathan makes $100,000 on his tax return, right? As his adjusted gross income. His limit in terms of his ability to deduct this year appreciated stock contributions is generally speaking going to be $30,000, right? So what he might want to do is either give the 30,000 this year. I mean, that's also a big gift for
Right,
somebody
that's
making
a huge amount.
$100,000. So as a practical matter, these don't bite too often, but they can. And the other thing is it can actually be carried forward, right? So let's say he did donate 60,000 worth of appreciated stock. Okay, he makes 100,000 AGI, adjusted gross income. He deducts 30,000 on this year's tax return. All right, we just push the remaining 30 in that example to the following year. It's no big deal.
That's
Wow,
interesting.
so this is a massive win then. I mean, this is something that for people with big unrealized gains, I mean, they who, like you said, which is
Yeah,
very important.
Yeah.
If
The
you're going
one
to donate anyway,
downside,
right?
yeah, the one downside is, look, it's an expensive way to get a tax benefit, right?
Well,
If
sure,
I've got,
It's if you're going to donate anyway, that's the key
yeah,
point,
this is,
right?
yeah, if you're charitably inclined anyway, this is just a real winner in terms of, hey, I've got these capital gains. I don't want to trip them. Let me throw that onto a charity that I was going to give to anyway, right? I mean, this is where the FI community plays from a position of strength, right? So, it's like, look, I have a checkbook. I can write a check, but I get a big tax benefit if I just go into my brokerage account and do this transfer of appreciated stock.
Yeah, that's incredible. So, all right, Sean, we're talking about tax planning. We've talked a lot now about donations, and capital gains distributions is where this started. But I guess you also touched in there about dividends and potentially where you hold dividend giving stocks or funds. Is
Yes.
that part of this tax planning as well?
It can be. So in terms of this particular idea, I look at dividends a little differently than I look at capital gain distributions, right? Capital gain distributions are just this thing that occur inside mutual funds and occur more inside actively managed mutual funds that don't add that much value, in my opinion, right? Just my opinion, to the investor, right? Dividends, on the other hand, are not a bad thing, right? They are corporate earnings that are returned to the shareholder. And today, a lot of dividends qualify for what's called qualified dividend income rates, which for many investors is 15%, but it could even be lower in terms of tax rate. So dividends are not the worst thing to have in a taxable brokerage account. Now, yeah, in a theoretical world, we might put all you could argue that any dividend investment should be in a retirement account where it could be tax deferred or tax free. I would argue in a qualified dividend income world, that's not that big a deal. Or getting some dividends on your tax return is not, to my mind, the end of the world. That said, you might want to look at holdings that are, if you're planning on having high dividend holdings, then you might want to look at parking those in a retirement account versus your taxable brokerage account.
Nice. Yeah, that's huge. So, right, we're not talking about, hey, change your life tomorrow, but this is just, like you said, in a perfect world, kind of 1% better, all things equal. If you can put dividend paying stocks into retirement accounts, probably to your benefit.
Well, can I add on just a couple of thoughts that were as we're kind of sitting with these ideas were coming to me because when we talk about financial planning, what we are looking at this through the lens of your taxable accounts, and although we have this very specific strategy that we really niche down on to talk about with charitable giving, really the larger picture that comes to me as you guys now are discussing capital gain, as you guys are discussing dividends. And Sean, you made the great point earlier and corrected me as I just quickly mentioned, like an individual stock. And you're like, no, that's not what we're talking about. We're talking about mutual funds and ETFs. Part of this tax planning is that we're identifying on Schedule D, line 13, basically a situation where we're incurring a tax event that we may or may not want, and likely in this case, if it's a surprise, we didn't want it. And so then, based on that, we are then say, well, what triggered that? And do I want to experience this, in years going forward? And now you've kind of given us kind of a general, although not specific, rule of thumb in that individual stocks, if you're a long-term buy and hold investor, potentially a decent option to hold inside of a taxable account because you're not planning on churning. You're planning on holding these things for the long term. You're not going to force any sort of capital gain distribution when you sell. Now, if you're a day trader, I don't think we have a whole lot of day traders that listen to us, but that's going to complicate things. And then as we kind of move down through this list, if you have an index fund like a VTSAX that you just own the entire market inside the United States, going to be probably a pretty decent choice for a taxable investment account because the capital gains distributions are going to be very low. But if you have a very, very niche index fund, which they only are in this index as long as they meet this very specific criteria, and then we sell it, well, now you're going to have more that shows up on Schedule D, line 13. And if you have an actively managed fund, that where they're trying to outperform the market by getting in and getting out. They're effectively day trading for you inside of these accounts. Well, now you have additional information about how that's affecting your tax planning. And maybe you make you're like either on the one end say, hey, how can I offset this? There's some sort of charitable gift transfer, or maybe money is fungible. Maybe do I look to start rebuilding this inside of one of my tax, deferred or tax deferred accounts or my tax sheltered accounts. So, I mean, that's just kind of my big takeaway as I look and start to understand what Schedule D, line 13 means. I look at the tax efficiency of my investments. And then based on that, I say, where do I want this to exist if I want it to exist at all?
I think that's a good takeaway, right? It's first of all, do I want this to exist at all? And then second, if I do, maybe I sell it and trip a capital gain or loss, right? I have to do that analysis, or maybe I do charitable gifting if it's appreciated, right? Or I just slowly get out of this position and then maybe even get into this position in a retirement account if I like it, right? So, yeah, it's a multi-factor analysis, but I think this is just the beginning of, hey, knowledge is power. I know I have this tax inefficiency. Now I need to take further action. I mean, I think that's the way I would look at it.
All right, so Schedule D, line 13, capital gains distribution. I hope that everyone feels comfortable with that concept, even if they're looking at that particular line on their tax return for literally the first time this year. Sean, what's next?
Next one is health savings accounts. And this is a choosify oldie but goodie, right? So if you have a health savings account, you contributed to it or you took a distribution from it during 2020, your tax return should have something called a Form 8889. So that's Form 8889. The big number to look at on that form is line 14C, distributions. Okay, so in most of the Choosify audience, I would say optimally that number should be zero or none or blank, right? Meaning you took no distributions. And why do I say that, right? Because I say that because HSA distributions should occur in only one of two circumstances, in my opinion, right? One is dire circumstances, right? So someone gets into a very bad disease, very bad accident, injury, disease, right? That's one. So dire is one. And then two is elderly, right? For those in our audience, 65 or older, an HSA is a great asset to start withdrawing on, right? Strategically. But yeah, if you're old, 65 or older, great time to start either paying for medical expenses, some Medicare premiums, or doing old reimbursements, right? But if you're not either dire or elderly, you should think long and hard before taking a distribution of any size from your HSA. So what does that look like, right? So you're married, you're 39 years old, you've got 2 kids, and you bring your 5-year-old in for their, for their physical, right? Generally speaking, what you should do is if you've got a health savings account and high deductible plan, is take out the checkbook or the credit card, pay for that medical appointment with the checkbook or the credit card, and then keep the receipt. And then many years down the road, reimburse yourself for the medical expense, right? So for your weekend warrior, for your physical, for your, hey, I had a little checkup or whatever, for those routine medical expenses, generally speaking, it's not optimal to use your health savings account to pay for that. Why do I say that? Because your health savings account is a way to keep money tax sheltered for many, many years, right? And then years later, you can reimburse yourself for your old medical expenses after that money has sat in that HSA for 20, 30, 40 years plus of tax-free growth.
And Sean, so a point of clarification is that is the advice. Well, that's the perfect world advice, but that's the advice clearly for people in the FI community, right? For most people who have an HSA, they put in some amount, they get a tax deduction, but most people need to reimburse themselves that year, right? So because cash flow is going to be an issue, but
Yep.
we're talking about advice clearly here for people in the FI community who ideally, if you have access to an HSA, you can max that thing, which I know for 2020 was $7,100 for a family. And then, like you said, you're not reimbursing yourself for every tiny, every time your child has a sore throat or something, and you have a $80 bill at the doctor. You're investing that money and letting it compound for decades. Am I kind of reading between the lines?
That's exactly right, Brad. This is a nickel dime concept, right? But I think the world, thanks to the good work of ChooseFI and others, folks are getting to understand the HSA and are appreciating it. And I think what we're seeing is a lot of people are contributing to it, but then the operational side, which is save your receipts, do not use it while you're not elderly or in a dire situation. That is still, percolating through the world of personal finance. And so especially it makes no sense. Hey, we're doing great, right? We've got $1 million saved up between all our different accounts and we're in no emergency. We have good jobs, right? And we're now going to use our HSA to pay $200 for a sprained ankle. It just makes no sense from a tax optimization perspective, right? So that's what we're talking about here. This is one of those little changes. Let's just let that money sit in a very tax advantage account, let that grow, and just pay for the medical expenses with our checking account or a credit card. And, of course, we pay off the balance every month and then we reimburse ourselves later.
So really, this particular one is more of a, hey, everyone, are you taking advantage of the HSA? I mean, really, line 14C, if we're playing this at the FI level, right, and we're gaming this out for the long term, it will always be zero because you're not touching it. If it is not zero, if it's a non-zero number, it's because you decided you needed that HSA money for some reason. It was a choice you made. You don't accidentally end up with your HSA money in your banking account. It was an intentional choice. And so now this is just us kind of reminding you, why? Did you really need it? Are you at a place where you could have cash flowed it? Where you could have, because there's a highly significant chance that if you do this, if you're in a position where you could max out your HSA for really just even 5 or 6 years, you're going to end up with hundreds of thousands of dollars in your HSA account at the point in life where you really, really need the money. And what you've effectively created is a compounding medical, funding machine that can spit out for you enough money to pay for all your medical bills for the rest of your life. You're basically self-insured, and there's massive tax incentives around using this down the road for those exact purposes. This is the only account that I think we talk about that is like the triple tax benefit account. Goes in tax-free, grows tax-free, and as long as you use it for medical related expenses, comes out tax-free. It's hard to overstate that. And so just take this as a reminder and make sure, though, you come up with a system. And Sean, you were saying this, get your receipts, file them away somehow. I personally use like a Google Drive sheet type idea. I think Brad does something similar. And then if we could tack on one tiny little optimization on top of that, if you are in a situation where you could cash flow your medical bills, why not use travel rewards to do it, right? Why not? When you get that expense that just came up, why not get that travel rewards card and use it to hit that minimum spend requirement and get yourself a free trip to, well, maybe not overseas right now, but certainly somewhere. All right, Brad, anything else you want to add on to that?
Yeah, I didn't. I like where you're going there, Jonathan. That's cool. I guess one thing, and Sean, this is gonna sound apocryphal or made up, but I promise I've gotten emails to this. I'm gonna make up numbers here, but really to this effect is, we talk so highly about the HSA that some people who have great health insurance plans through their jobs feel like they're missing out. I've actually had an email like, "Oh, my premiums are only $50 a month through my employer, but I really, really want to invest in that HSA." And they're talking about like, "Oh, I've got to go on, whatever the ACA, and it's $1,000 a month in premiums." And I'm like, "Oh, please, please, please don't do that."
I used to be one of these people, Brad. I did, and then I started having to pay the premiums. I used to be one of those people.
Yeah, you don't want the HSA that badly. So, obviously that's an extreme example, but Sean, could you quickly talk through just like that concept? I'm giving kind of the crazy high level version.
Yeah, so this is where personal finance is more than just numbers and more than just taxes, right? So, your mileage may vary based on your circumstances, right? So it depends on what your employer is offering. And I think what we're going to see is with a lot of private employers, they're going to move towards these high deductible plans and towards HSAs. And for many people, it's going to be the more attractive option based on lower premiums, right? But there are plenty of either private employers or government employers still that have very comprehensive plans that are not high deductible health plans. And that's okay, right? If you're getting $25 a month for gold plated insurance, you're winning and you're winning. Then, all right, so you don't have this tax win, but you have all these, you have low premium win, you have great coverage win. All
Yeah,
right, it's
you
sort
are
of like,
winning, believe me.
it's sort of
Yeah.
like if you're a New York sports fan and your team wins the Super Bowl and the Stanley Cup and the NBA championship, but you didn't win the World Series, it was still a pretty good year, that sort of thing.
Take the $1,000 that you're not spending in premiums and choose any one of the other accounts, and you'll be just fine. Everyone, you'll be just fine. I've now seen both sides. I was that person. I was like, oh man, I mean, I'm paying $100 a month, $120 a month for my family and premiums, but I don't have the Brad. Literally, man, I hear mad finances and all these people talking. I just want the HSA, and then I became an entrepreneur, and I started paying the bill for the premiums, and I was like, I really want my $100 plan back.
Yeah, no, it's tough. It is tough. But yeah, so I think all right, Sean, we've talked through the HSA really thoroughly. So what's up next here on your list?
So the next line to look at is actually on the first page of the Form 1040. It's line 4B of the Form 1040. It's called IRA distributions taxable amount. So what the heck are we talking about here? We're talking about the so-called backdoor Roth IRA. And fortunately, this is something that I and many others in the FI space have written, ad infinitum. It's a transaction where you have two independent steps where you fund a non-deductible traditional IRA, do a close in time conversion to a Roth IRA. And if all the ducks are in a row, that could be a very tax efficient way of moving money essentially from taxable brokerage accounts we were talking about earlier into Roth accounts. Okay. So what are we talking about here? Well, if you're doing this so-called backdoor Roth IRA strategy, um, your number in line 4B should be a very small number. Okay. It should be in the single or double digits at most. If you look at your 2020 tax return, you say, oh, yeah, I did a backdoor Roth IRA. Of course I did. And then you see thousands of dollars in that box 4B, as in boy, not box A. Box A is going to have a bigger number, right? This is the amount that's taxable on that backdoor Roth IRA. What that means is either one of two things. Either one, you misreported your backdoor Roth IRA. And if you did, okay, fine. There are chances to amend your tax return and get a tax refund. Or it might be that, oh, yeah, you're doing this backdoor Roth IRA, but for your circumstances, because maybe you have a big traditional IRA out there, it's actually not a good idea. And so don't do that tax planning in the future. This is one of those, okay, fine, maybe you did it when you had a big traditional IRA. It wasn't optimal. It's not the end of the world in any way. but maybe in the future, don't do that planning technique. So this is either, correcting an old mistake if there's a mistake, or just knowing that in the future, maybe the backdoor Roth IRA is not a good idea for you. When I say it's not a good idea for you, I generally mean folks who have large traditional IRAs, SEP IRAs, or simple IRAs. And there are people who have those, they rolled over an old employer plan or something like that. And it may just not be the right tool in the toolbox for you, and that's okay.
And what you're referencing, I believe, and you will correct me if I'm wrong, I'm positive, is something called the Prorata Rule, which is like a mixing of these two statuses, some that are pre-tax and some that are, or some that are tax deferred and some that have already been taxed, which is causing this, maybe you can help me break this number down, but I believe that's what you're talking about.
That's exactly what I'm talking about. So, if you have no traditional IRAs, no SEP IRAs, and no simple IRAs, when you do the second independent step of the backdoor Roth IRA, the Roth conversion step, what's going to happen is, okay, I made a $6,000 non-deductible contribution to my traditional IRA. I have no other traditional IRAs, SEP IRAs, simple IRAs. A month later, I go back into the account. It's grown to $6,002, right? I'm going to do my Roth conversion for the whole balance, the $6,002. And my box 4A will be 6,002. That's a total amount I moved from traditional to Roth. But then my taxable amount in my example is $2, right? That's the expected return or expected result from my backdoor Roth IRA. That's tax efficient, great. But let's say, I did that with, let's just say I did that with Vanguard, right? Not endorsing any brokerages. I'm just giving you an example. But separately at Fidelity, I have a $100,000 traditional IRA from my old job, say. Okay. So when we do that math, what's going to happen is I'm going to have to use this pro rata rule to only recover a piece of that $6,000 contribution I made, right? I was able to recover all 6,000 in the first example, but essentially what happens is of that $6,000 contribution, the $100,000 at Fidelity attracts basically 100 divided by 106, right? Almost all of that contribution gets allocated to my $100,000 traditional IRA. So when I do this $6,002 conversion, I only get like $300 or $400. And so about $5,600 is going to be taxable to me because of this pro rata rule. I have to allocate my $6,000 of contribution between those two IRAs, the 6,000 I just established and the 100,000 I separately have. And so that's why if you have one of those old traditional IRAs, SEP IRAs, simple IRAs, backdoor Roth IRA without additional planning, just not the right transaction for you, and that's okay.
Or there's one, and then this is really where I was going with that first question, is there's an extra step here, that people need to consider. If you want to employ some sort of backdoor strategy, and this is your second or third employer, and you have this big IRA account that's been established for a long time, in order for you to be able to move to a situation where this is going to be viable for you, you're going to want, because the one you didn't mention was the 401k. You're going to want to look into either with your current employer, or if you're an entrepreneur, figuring out how to get that IRA, all that money that's in the IRA, into your new employer's 401k, or into, if you're an entrepreneur, into your own solo 401k. Is that accurate?
That's exactly accurate, Jonathan. You want to be careful about that. And generally speaking, you want to do what's called a so-called direct trustee to trustee transfer. And that's a way, and I've blogged on this, others have blogged on this. That's a way to clean up your old traditional IRAs, SEP IRAs, simple IRAs, so that you're able to do the backdoor Roth. Now, again, we're not here to give investment advice for any particular person. You do want to look at the investment options inside your employer 401k. You want to look at the fees, right? So maybe it's just better to have a low-cost traditional IRA at a brokerage that you like versus rolling into a employer 401k that you don't like. Either maybe you don't like the investment choice, maybe you don't like the fees, maybe you don't like a combination of that. So again, personal finance is personal, and it's not just, boiling down
hugely
to a tax
important caveat that you put on there. I would never roll into a 401k that had really, really bad plans just so at some
Yep.
point you could use this tactic. That would, yeah.
But Jonathan, your mind is at exactly the right place.
Thank you, sir.
Yeah, Jonathan, it's cool because we're on the same wavelength. I was just about to jump in about the similar concept, but the opposite, which is, we talk about people who have 401ks at an old employer who are thinking about, hey, should I roll this out and into my own IRA that I control? Again, we're not giving advice, and of course, it's important what the funds are, et cetera. But that might be an additional point of consideration if you're looking for that tiebreaker, right? Like, hey, I was thinking about doing the backdoor Roth, but this is going to really screw that up if I have a traditional IRA. Okay, then maybe leave that old 401k as is. So again, this is like at the ultra margin of decisions, but if it's that tiebreaker, it's something to consider.
Well, this is a marginal improvement episode, so this is the perfect place for it. Sean, let's go ahead and move on, man. What do you got for us next?
The next one is Form 8995, which is a relatively new form. Form 8995. There's also a second version called 8995-A. This is line 2 on that form. And what this is, folks will ask me sometimes, should I self-prepare my tax return or should I hire a paid preparer? And there's no just right or wrong answer on that. But this is one of those, hey, if I've got a number in line 2 of that form, that's a bit of an indicator. Maybe I should hire a tax return preparer and or financial professional or tax professional to do some planning. So what is that? Amounts in this line 2 are essentially qualified business income, right? So that's income that comes from self-employment or a small business that qualifies for something called the qualified business income deduction. We're not here to go into the nitty gritty of that because that is a somewhat complicated topic. But what I'm here to say is this is like a signal to you. Hey, if I've got a decent amount in this box, I ought to be thinking about some tax planning or at least a tax return preparer. Right now, my return is not a 101 return. My return is at least a 201 and could maybe benefit from tax planning and or a tax return preparer.
And the only thing I would add on to that is I actually think for the individuals that, got fixated on that qualified business income, we dedicated, I think, a pretty significant portion of an episode, actually one that we recorded with you, to that topic. I tried to just Google it. Yes, that is the way that I find content on our website. And I was able to track it down in episode 274. So for those of you that are interested in Sean's going into a little bit more detail on that qualified business income, that's one to look at. But I love just this kind of short synopsis. Like, if you have something showing up there, you got a 201 tax return, right? This is no longer an easy form. There's some pitfalls here. Get a professional. And having that as a litmus test, Brad, is probably smart to have.
Yeah, no, this is critical. And what's cool, actually, while we're doing this episode, I have my 2020 return in the background here, the PDF, and I'm going through this. And yeah, Sean, so for anybody in general terms, and again, this is very, very broad, but this would be if you're getting a K1 from some type of business that you're a partner in, or I'm even seeing on the 8995 some investments that I have that I get K1s, and that shows up here on the QBI. Again, very broad strokes. We're not trying to give any advice, but it's just, okay, this might be something you consider, right? Like, and there's some interplay here between the business income and wages, I think. And I know we go into that on the other episode. Yeah. Again, that's far outside the scope of this, but those are the type of people who should be considering this, right?
Those are the type of people, and then people with Schedule Cs, right? So side hustlers, even, your side hustlers, your sole proprietors, those sorts of folks should all be looking at this, and there could be a planning opportunity there.
Yeah, and it's massive too, right? Because this is 20%, the potential, right? That's the deduction is very roughly, again, broad strokes, 20% of your business income is just a straight deduction. So there's massive, massive potential here. And you do not want to either omit this, just entirely mess it up, or, get the calculation wrong. So yeah, I agree totally, Sean. This is something professional advice is really important here.
I think people don't necessarily make the connection that when you minimize taxes, you're maximizing your income. Right. So, every dollar that you can keep here using the rules provided is a dollar that can go towards your goals. I mean, these are really, really high value touch points for people. So, Sean, anything, any kind of final thoughts or final ideas that we want to cover as part of this strategy?
Yeah, the last one is just looking at your adjusted gross income in 2020 because of the stimulus payments, right? So people remember the beginning of coronavirus, stimulus, world's changing, things are crazy. Well, there was a stimulus in early 2021 as well. And for those of you who are single out there, if your 2019 and your 2020 adjusted gross income was over $80,000, for those of you who are married, if your adjusted gross income in both those 2 years was over 160,000, you probably received zero 2021 stimulus. But guess what? There's still a chance to get it. However, you've got to get your income below, or your adjusted gross income either below 80,000 single, 160,000 married filing joint. I did a blog post about this concept, and it folds in one of my favorite topics, and a topic I'm working with Choose FI on right now, with my upcoming book on the solo 401k. Right, solo 401k is an opportunity to lower your adjusted gross income, which is great because you get some tax deductions. Okay, fine. That might be really good for you. But 2021 is a unique year in this regard. And if your adjusted gross income last year was above a certain point, it may be the case that you could lower your adjusted gross income in 2021 through, if you're self-employed, maybe a solo 401k, maybe just increasing your workplace 401k plan contributions. Maybe it's going to an HSA. And there are different ways you could do this. And not only do you get a tax deduction, you might gin up your stimulus for 2021 big time. That was $1,400 a person, including qualified children, right? So I have this example on my blog where someone moves from a SEP IRA to a solo 401k. They've got a wife, 3 kids, and they go from zero stimulus to 7,000 in stimulus,
Wow.
plus the tax deduction.
Wow.
So this is just a year you should be looking at your AGI. Look, if it was $300,000, $400,000 last year, and it's going to be that this year, all right, fine, don't worry about it. If it was 40,000 last year, you got your stimulus check already, fine, don't worry about it. But for those in the middle where maybe you didn't get your full stimulus, this is something you should be thinking about.
Man, this is huge. This really is huge. And it's we're taking like this defensive strategy, or almost this, I wonder what will happen. I wonder how big my refund will be this year, to, all right, I know the rules of the game. I know how this works. Here's how I want to strategically position myself each year going forward.
Yeah, Sean, I absolutely love this. And just kind of talking about the stimulus, I guess one other piece that I guess there's been some news recently is the child tax credit. I was hoping
Yes.
you could give some info on that.
Yeah, this is somewhat complicated, and I must admit I've not
Yeah, it's
dove
brand new, right?
fully the way there. But essentially, there are child tax credits, and what they did for 2021 is they increased them and made them payable up front. So there are folks now getting monthly checks from the IRS for their additional child tax credit. Now, that's based though on 2020 tax returns, generally speaking. So let's say you made too much in 2020 to qualify for this enhanced child tax credit. Again, what do? You go to your 2020 adjusted gross income, you look at your 2021 numbers, and you find a way perhaps to reduce your 2021 adjusted gross income. And it could be as simple as, hey, I contribute $10,000 to my 401k at work. This year, I'm going to max it out, right? So I'm going to get below these adjusted gross income thresholds. But you're absolutely right, Brad. There are opportunities. Adjusted gross income is something we always love to control for anyway. Based on the way the stimulus and the additional child tax credit have been structured, 2021 is just a year where for certain people in the middle, it's just such a differentiator from a tax perspective that this year you want to be thinking about your adjusted gross income in a significant way.
Well, just to put that in perspective, I mean, because there's these very kind of strict cutoffs at which point stuff goes
Yes.
away. And since we have a lot of tools at our disposal to make our income look lower, and I mean, these are tools that the government wants you to have access to. You can make your income look lower by saving for retirement. You can make your income look lower by throwing extra money at your 401k. So you could make a decision, well, you know what? We're going to put an extra $7,000 in our 401k this year. And guess what? because you happen to be one of these in the middle type people and you know where the numbers are that dropped you below the threshold, qualifying you for some sort of tax credit that then to you was worth $7,000. I mean, in this very extreme hypothetical, but anything in the middle is pretty amazing because the money, unlike that first example where we said, all right, well, you donate it to a charity of your choosing. And, if you were already planning on donating to a charity, then this will be viable. What we're talking about is you're just saving for your future. And then they're just giving you all the money to replace it via a child tax credit.
I gave an example on my blog where I maximized a hypothetical solo 401k contribution and the tax saving rate was over 50%. So you're saving for your future and the IRS itself is essentially funding half of that, right? That's a pretty winning strategy. And if you do things right, you actually have into 2022 to fund a 2021 solo 401k contribution if you do things right. So it's like, wait a minute, the IRS is going to pay more than half of this anyway. And I have until potentially into October of 2022 to fund this. That cash flow can work out for a lot of people, even folks who are not, $300,000 tech job or whatever, right? You can figure out ways to make that cash flow work.
Yeah, Sean, this is fascinating. So this year of all years, people really need to know where they stand. And if there are additional tools that can get you under some of these thresholds, it might be worth, like you said, 50%, right? Like when we're talking about tax credits. And I think that's such an important thing because a lot of people don't know that is a dollar for dollar reduction in your tax liability. Or, in this case, this tax credit, this child tax credit, like that is dollar for dollar coming back to you. It's not a deduction, right? Like, and I'd love for you to put in your words because that's such a critical understanding. Like one of the things we're doing here at Justify, we're trying to just get people up to speed on this terminology because it's so important, right? Like understanding the difference between a tax deduction and a tax credit is critical. And most people simply do not understand that.
Yeah, tax credit is just a dollar for dollar reduction in the tax you owe the IRS or your state. Tax deduction is great and it's valuable, but it's valued based on marginal tax rates. So that we have a progressive tax system, and we're actually in a period of relatively low marginal tax rates vis-a-vis US history, right? There have been times where the marginal tax rate for the very top was 90% or 70% or 50%.
90%?
As late as, pardon?
90%?
90% was after World War II. I mean, there was issues with, hey, we want to sort of suppress certain production and whatnot. Kennedy cut taxes from 90 to 70% for the highest tier. Then Reagan came in 70 to 50%. Then in 86, they did 50 to 28%. Now it's gone back up. But for a lot of folks in the middle, we're looking at historically low rates, meaning tax deductions are worth something, but they're not worth quite as much as they were way back when. So, but that just goes to, hey, today a tax credit's even more powerful because a tax deduction, while valuable, isn't quite as valuable for many people.
See, I like to always look at the bright side. So when you have a 90% marginal tax bracket, think how much the government is giving you when you contribute to these retirement accounts. It's like they're giving you 90. It's like, what a gift. Oh my goodness. All right, Sean. Wow, man, this was great. I really think you helped us make the shift to tax planning, which is what we wanted to accomplish with this episode. And we're grateful to you for coming on. The articles that you referenced throughout the episode will be linked. All of them will be linked in the show notes for today's episode. So for those of you that are trying to just dig into Sean's content, let me encourage you. You can find all those links at choosify.com/332. That's choosify.com/332. And I would highly encourage you when you're moving off of defense into offense with regards to tax planning that you go check out the FI Tax Guy at FITaxGuy.com. Sean Mullaney, thanks so much for joining us on the show today.
Jonathan, Brad, always a pleasure to join you and speak with you and your audience.
All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.